Tim, there's nothing like making everybody feel good before your presentation, but I think I accomplished that. How you doing today, buddy?
I'm doing just fine. Kyle, is the mic working okay?
Everybody hear Tim all right? Go ahead and pipe into the chat for us. All right, looks good. Well, Tim, let me give you a bio because anything I say isn't really going to do you justice. But Tim Melvin was somebody that when we started Benzinga, our parent company, 4.5 years ago, he was someone we looked up to, both myself and the founder, Jason Raznick, because Tim was one of the luminaries in value investing. And he was one of the guys that I have read every single day for the past several years. Value investing is a time-tested and time-proven strategy, and nobody does it better than Tim. And what he's teaching today are his 8 rules. And I had to beg him to give some of the stuff that he's giving today because it's a lot of the things that you can go out and actually do research and actually look up stocks yourself. And although timing and the things that go into it are a lot more complicated, Tim really brings together something that we can all understand and this is really important, that we can all truly make money off of, okay? So Tim is a portfolio manager. He is a practitioner of the Benjamin Graham School of Value Investing, as I'm sure we're all very aware of. He was a stockbroker at Morgan Stanley. If you Google Tim, you will find this guy absolutely everywhere. His work's featured on Real Money, Daily Speculation, the Wall Street Digest. We put him on Benzinga all the time and syndicate this guy just everywhere because his work is incredible. Tim, before I go any further, I just want to thanks for coming in today. It's been absolutely awesome having you on the site the last 3 months, and I think we are all ready. I think we got everybody's audio working. We are all ready for you to come in and teach us something that we all truly need to listen to today.
All right, great. Thanks a lot, Kyle. That was a great introduction. I feel more important than I was before I got here this morning. I just want to walk you guys through, and I've been kind of following along here at home today, and you guys have listened to some fantastic presentations. And I'm sure some of you are asking, as you probably should be, what's a value guy doing in here amongst all these great traders? Now, there's 2 reasons that I think everybody, whether you're a trader, however you classify yourself, should listen to this presentation today. First and foremost, in my money management accounts, about half of my business over the years has come from traders from Chicago and from New York, the old floor guys, the hedge fund guys, who are continually moving money out of their risk accounts into their long-term accounts. Almost all of those guys use a value methodology to manage their long-term accounts for retirement or their kids' education, whatever that goal might be, because it provides the highest return with the least risk. The second reason, of course, is no matter how great the ideas or the systems are, trading's not for everybody. That's just a fact. And if you have a family, you have outside interests, you have a career, you're running a business, sometimes there's just not enough time to be a trader. Value investing is going to give you a way to earn the rates of return that you want to get on your money without having to be tied to a screen 8 hours a day. So today we're going to go over some things. What is value investing? Exactly, what are they talking about? It's a term thrown around constantly in the media, but most people don't really understand it. Going to touch on why it does, in fact, and has for decades surpassed every other approach to investing your money on a long-term basis in the stock market. And then, having had my arm bent thoroughly up between my shoulders, I will give you my 8 rules for picking the perfect value stocks and kind of go through how you separate the good ones from the bad ones. Not all stocks that are cheap are a wonderful opportunity. Good percentage of them actually are on the way out of business. Then we're going to talk about some of the things that we've done in the last 10, 13 years. If you look at 2000 to 2009, for example, the lost decade, every long-term investor that was in mutual funds and ordinary accounts lost money. Using our specialized approach, we handily beat the market and delivered outstanding absolute returns to our investors. So I kind of want to show you some of the things, how we accomplish that. And then I'll also touch on where you should invest right now. It's Nick referred to it just a little bit ago. It's been easy so far in 2013 for a lot of people, but it's getting a little more confusing now. We have taper talk coming in. Interest rates have come up a little bit. It's not quite the easy game that it might have been back in January. So that's basically what we're going to cover today. All right, what is value investing? You hear this on the news all the time. This guy's a value investor. That guy is a value investor. And then you listen to them talk, and they're talking about we're going to buy this stock because it's cheap. It's got a 20 PE, and the rest of the group has a 30. Or this stock's only gone up 10% when the market's gone up 20, so it's cheap. That's really not how value investing works. As outlined by Ben Graham 90 years ago and perfected along the way by guys like Marty Whitman, James Montier of GMO, what we're trying to do with real, honest, asset-based value investing is we're trying to buy stocks way below what they're worth as an ongoing business. And the market is such a psychological freak show that it gives us opportunities to do that all the time. I've developed over the years, and I've been doing this 27 years now, guys, so I've kind of seen everything come and go. I've tried most of it twice just to make sure that it really didn't work. And along the way, I've developed a set of rules for identifying those stocks that are wildly out of favor on Wall Street, or trade very cheap, based to the assets that the company owns and the earning power that the company actually has. And these rules are very effective. They work incredibly well. Price to book value ratio is absolutely my most important number. I'm looking to buy assets for far less than they're worth. If I can buy out a $10 pile of bricks for $6 and turn around and sell it back at some point for 10, that's exactly how I want to run my portfolio as well. I want to buy things for way less than they're worth and sell them when they come back into favor or business conditions improve. So price to book value is our absolute most important number. It's the number I use to key off in all of my investment decisions. Basically, when you're doing this, and we're going to get into this a little bit more as we go along, value investing, especially focusing on this price to book value ratio, forces you to buy low and sell high. And that's kind of the idea of the market, but most people have a hard time with it, because when you're buying low, you're usually buying something that nobody likes, or the market's falling down around your ears. And then selling high, you're selling when everything's very popular, everybody's excited, your neighbors and coworkers are just so happy to own stocks and bragging about their returns, and you feel kind of silly if you sell out of the market because everybody else is still in. But there's a methodology and a way to achieve buying low and selling high. Keying off that price to book value ratio is an enormous part of that equation. Why value investing? Value investing was developed by Benjamin Graham back in the late 1920s and 1930s. It has consistently worked for that 90-some years period of time. Over just about every market cycle that you care to look at, buying stocks below book value has beaten the market, it's beaten other methods of investing, and it's done it consistently. It occasionally outperforms for a year or two as market cycles change, and that's particularly true as we come into the last periods of a bull market where things are running like crazy. The value strategy might lag behind. However, most of the time, you're going to make more money over that normal few-year market cycle using a value approach than any other method for long-term investing that's out there. Again, we've developed the rules and tools, I'll call them, that actually improves just buying price to book value, consistently outperforms the market. Been using this for a long, long time with just stellar results through good markets and bad markets. And again, your biggest advantage as a value investor is that nobody else is doing it. They're doing relative value. They're trying to imitate Warren Buffett, who is, they always refer to him as a value investor, but because of the size of his funds under management, he really hasn't been a value investor in the strictest sense of the term since probably the late 1980s, although he did make all of his original fortune using very similar techniques to what I'm going to show you today. So it is the best way to invest your money, particularly for a long-term investor, and I actually believe I can teach you how to do this and incorporate it into your investment practices. I've done it for a lot of people over the years. All right, value investing, it not only works, it works well. And there's a lot of studies, but rather than clutter up this presentation with a ton of charts, and we've only got about an hour together today, I'll refer to the most important one. Feynman and French are the name of two professors at the University of Chicago, and they set out really to prove that the markets were efficient, that you could not beat the market over time. What they found was exactly the opposite. They examined stocks in the United States from 1963 all the way up through 1990. So you've got a nice 27-year study period there. What they found, in fact, was that smaller stocks that traded below book value absolutely trounced everything else out there. They clobbered the popular stocks, the Nifty 50s and the new paradigm stocks that we saw during the internet bubble. Whatever was the popular stock of the day that was trading at a very high multiple that everybody loved over the decades. It outperformed those exciting stocks by a 3-to-1 margin, and it better than doubled the market's rate of return over that period of time. Now think about 1963 to 1990. That was a pretty good period. You had a strong run up in the 60s with some give back in the 70s, and then the 1980s were enormous. I think on average during that period of time the market earned right between 9 and 10%, including dividends. Using a value approach, buying stocks that traded for less than the asset value of the underlying corporation and selling them when they became fully valued allowed you to earn double the rate of return of the stock market as measured by the S&P 500. Now, when they did this study, they broke the stock market up into groups of 10 deciles. Academics love big words, so they broke them up into deciles. The lowest 4 deciles of stock size and price to book value clobbered the market. They all beat it. Even the larger cap stocks that traded below book value beat the overall stock market by more than 50%. We have other studies. I'm happy to share them with you, and will some in the seminar next week that we're going to do, that prove that this goes on well beyond 1990, even right up through today. Value strategies have continued to just clobber the overall stock market. All right, my 8 rules for investing. Develop these rules over a long period of time, lots of testing, certain amount of trial and error and misery on my part. So hopefully by paying attention to my rules, we can spare you some of that experience. First off, book value matters, and it matters a lot. And during the various cycles of my career, I've heard that book value doesn't matter anymore. It doesn't matter anymore because technology stocks use intellectual capital, not real capital. We all know how that one ended. They don't matter because financial institutions today can earn such a high return on assets that we don't need to worry about the actual size of the assets themselves. Fact of the matter is book value, the asset value, how much stuff a company has, is actually critical in the investment process, and those that ignore it are leaving an enormous amount of money on the table. Second rule, I totally stole this one from John Templeton, one of the greatest investors of all time. Buy maximum pessimism. When everybody else is scared to death, selling stocks, burying money in the backyard, and would rather drive nails in their kneecaps with a hammer than buy stocks, that's when you want to buy stocks. This takes an incredible amount of discipline because it's a very scary endeavor, but it's where the most money is made over time. Third, don't do what everybody else is doing. And this is, again, stolen from Mr. Templeton to some degree. If everybody else is trading the same 8 or 9 or 10 stocks, they're all buying growth stocks, or they're all buying bonds, whatever everybody else is doing, if you want to outperform the market and make money, you simply can't do what everybody else is doing. You have no edge, no advantage. Average is going to be your best result. Margin of safety is critical. You should have this on a throw pillow, a wall rug, a tattoo, whatever it is. Margin of safety was first coined by Ben Graham in the original edition of The Intelligent Investor. It is the most important thing in investing. You win by not losing. 5, scale into stocks. You don't have, if you see a stock that you like, or I send you a recommendation because you're a customer of my newsletter, don't go out and buy a full position or put all of your money into that stock at once. 90% of the time, my stocks are going to go down before they go up, and that's true of all value stocks. They're not popular. There's selling pressure in the stock at that moment in time that has created that discount to the underlying value. So scale in. Now, I've developed some tools that will teach you exactly where to scale in, and we'll talk about that as we go along, and certainly more in detail in the seminar next week. 6, react, don't predict. Very few people can predict the stock market. Lots of people will tell you that they can. You should run away from those people. Henry Kaufman said it about interest rates back in the 1980s. It's true about the stock market. I know some guys that are fabulous predictors of the stock market. They have degrees in physics, math, statistics, and they're pretty good at telling you where the market's going to go over the next 4 or 5 hours. Anybody that tells you they know for certainty where the market's going to go over the next 3 months, 6 months, or a year, put your hand on your wallet, exit the room at a high rate of speed. You want to react to what the market does. We'll talk about that a little bit more also as we go along. But if the market's coming down around your ears, you want to be a buyer. It's giving you an opportunity, and the reverse is also true. Patience is profitable, and impatience hurts people more than anything else when it comes to the stock market. You have to sit and wait for the opportunity to buy and then hold the stocks for a long period of time. A couple speakers have touched on this so far today. You have to hold it until it trades for what it's worth. Just trading in and out because you have a short-term profit and it feels good to take a profit is a recipe for disaster over the long run in the stock market. And 8th, don't play just because the casino's open. I'll talk more about this, but that's just a dangerous attitude that the market's open, I have to do something. All of Wall Street, all of financial media is geared to make you want to play because that's how they get paid. You have to ignore that impulse. You don't have to play every day. Book value matters. This is the key of my investment philosophy, and it's not just an individual company analysis, although I'm certainly going to get further into that. But this is something called the Tobin-Q ratio, which was developed by a professor, oddly enough. All this does is it compares the value of a company's assets, the actual value of them, to what they're trading for in the stock market. When it is over 1, the market's considered overvalued. The market value is far in excess of what the assets are actually worth. When it gets down under 1, and you can see the normal line is this black line going right down the middle of the presentation here, that's about the historical average of it. Look at when it's below that average. All through the mid-1970s, up into the 80s, coming all the way up into the 90s, doesn't go over it into the mid-90s. Here in 2008, when corporate America's assets are on sale, it's a great time to be buying stocks. When they're no longer on sale and fetching premium prices, it's probably a pretty good time to take a much more cautious approach to the stock market. Certainly not a precise indicator by any stretch of the imagination. You can't trade S&P index futures off of this, but it's just like a risk gauge that's in the market. The value of assets matters very, very much to a long-term investor. Okay, book value matters. We've talked about this constantly over the last 3 or 4 months. We've seen unprecedented yield chasing over the last couple of years. With the Federal Reserve holding interest rates down at basically 0, money has been flying around the market looking for a place for dividend income, any type of yield that investors can get. This has pushed all these big blue chips that we were able to buy back in 2008, 2009. These things were trading right around their asset value. Some of them got the discounts to their asset value, which is pretty unusual for your large mega cap blue chips, your electric utilities so much as your phone companies, your drug companies, your McDonald's, Coca-Colas, were all on sale at bargain prices. Disney sold for about two-thirds of the value of its assets at one point in time. They were great buys. But they have just been pushing these stocks. They're now way above their book value. They're selling at several times their book value. They're above the most optimistic valuations that you can make about what the company's worth as an ongoing business. In spite of the fact the economy's still pretty weak, these guys maybe will have single-digit earnings growth for the last couple years. In spite of that, they're trading at premium valuations because people are desperately buying those dividends. It's very, very dangerous practice. Focusing on book value helps prevent you from making the same mistakes that everybody else is making in the stock market right now. Another example, and believe me, as a long-term value investor, there's nothing I love more than REITs on sale. If you can buy real estate on sale, that's just a fabulous investment opportunity. It's been that way for the 27 years of my career. But look at what's happened to the REIT sector, especially the larger REITs, that should normally trade right around book value and maybe 1.5 times book value for the premium REITs. Money's flowed in looking for a home, and it's coming in through ETFs and through funds who pay absolutely no attention to valuation. It just gets the money to work and collect the dividend. Simon Property Group operates malls. Based on the economy in the country, it's a fantastic operator and one of the largest REITs. 1.5 times book value would be a great valuation. It's at 7.9 times. And you can just go through this. Public Storage, fantastic company. 5.1 times book value, great company. Stock price is way too high relative to the assets that they own. Avalon Bay is apartments, starting to see the same story. 1.8 times book value. That's too high relative to the value of the property. Vornado Realty Trust, 2.6 times book value. You're seeing the same thing over and over and over again. These assets have become just simply too expensive in the stock market. The market's putting a higher value on them than they're actually worth. Focusing on book value helps prevent you from making these critical mistakes of buying things for way more than they're actually worth in the real world. We use 80% of book value as our entry point for most of our stuff, and certainly for anything connected with real estate. We want to buy it for 80% of the tangible net worth or book value of the company. Compare that 80% of book to where some of these things are trading, and you get an idea of just how severe the overvaluation is. This is a simple chart, but it just shows you, it goes from 1951 up through 2009. You have earned a good solid 50% premium by buying the stocks, and this is regardless of market capitalization size or anything else. There's no credit checks or anything else, any other evaluation, just the lowest price to book value. You've earned a healthy premium to the more expensive stocks and to the market itself, and that's existed over 50-some, almost 60 years, according to this chart. Value investing works. It works extraordinarily well. It has for a long period of time, and for a lot of reasons, it's going to for a long period of time still to come. Buy maximum pessimism. This is a critical rule. It's one of the hardest things you will ever do in your entire lifetime. Look at the last few periods as marked by the green arrows here on the chart. Now, hopefully a lot of you guys were around back then. But if you remember 2001, how many people remember? And just throw a yes or no into the chat, and Kyle can let me know what the results are. How terrifying that actually was as a period of time. 9/11, of course, made things much worse. But if you just the internet boom and then bust, because everybody had been so confident that these things were going to the moon forever, and now all of a sudden it just seemed like the world had ended and prices were plunging. Nobody wanted to own stocks. They were standing in line to get out of the doors. It was a very, very, very scary time to be putting money to work in the market. But it was also this 2001 to 2002 period of time, the aftermath of 9/11, up through about here at the end of 2003, was probably the most fun I've ever had as an investor. Just speaking from a purely fundamental point of view, Priceline traded for less than cash. They had about $3 a share in cash, and the stock traded around $2. Apple was below book value. You just had so many incredible bargains around. People were dumping out. You were the buyer of last resort, and it was just a great time to be a buyer. Now let's move forward to the next one that we've marked here, 2008. I'm sure everybody in the room remembers this, or at least has some reference to it. That was horrifyingly scary, and I was as scared as everybody else. Lehman Brothers was gone. Bear Stearns was about to go. There were questions about Merrill Lynch surviving, Bank of America. It looked for a while there like the entire financial system might come down on top of our ears. But assets were cheap. They were incredibly cheap. They were just solid, wonderful companies that were not going to go out of business, that were trading for fractions of what they were worth. Again, you were the buyer of last resort. People were dumping stocks. Get me out at any price. I've lost enough money. I want out of this thing. And if you're buying at the point of maximum pessimism, you were standing right there and in a position to earn this inevitable profit that followed from them right up through today. don't do what everybody else is doing. This is my third rule. It's incredibly important. The average investor makes a bunch of mistakes. First off, they're time constrained to a very large degree. So they're relying on sales pitches and advertising to help them select their investment, and they're switching too much. The average investor in a long-term account trades entirely too much. By the time they're paying even low discount brokerage commissions and the bid-ask spread, they're giving an enormous amount of money away. If you look at this chart, this is by Dalbar Research, 20 years between 1992 and 2011, the best performing assets was oil. Stocks, in spite of two rather horrendous moves to the downside, came in at a respectable 7.8%. Go all the way over here to the right-hand side of the screen. The average investor over that 20-year period of time, if he just sat still, he would have made almost 8%. Instead, they've underperformed housing values, which had just collapsed by 40%. They've underperformed inflation. They've underperformed everything that you can possibly think of by making the same mistakes over and over and over again, trading too much, buying whatever's hot and popular. Do not do what everybody else is doing. If you do, you're going to be that guy lagging way behind the market. Again, you talk to just about anybody in the market today, and they've got price targets and they've got time frames, and they're looking for 20% gain here. What's the stock going to do over the next quarter? That's not the right way to do it. We have a hold until it works or changes philosophy. When I buy a stock, I'm going to hold it until it works. And by works, I mean go from the discount to book value, and then eventually we have a higher target number we call the intrinsic going concern value. Whether this takes 6 months or 6 years, unless the fundamental and credit condition of that company changes, I'm holding the stock. Nobody does that anymore. The average holding period has come down so far over the last 20 years. It's gone from like 2 years to around 6 months as a holding period of a stock. You don't buy a business for 6 months. Don't buy a stock for 6 months either. And then, if there's no value in the market, you do what this guy does. You go for a drink, hang out, have a nice little gin and tonic. Hopefully you get it at a happy hour price, and you wait for bargains to be created in the stock market. Don't play just because the casino's open and do what everybody else is doing around you. You have to stand opposite from the crowd. Margin of safety, again, I cannot emphasize this. I'll go over in the seminar a little bit late next week that Kyle's going to tell you about at the end on how to create a margin of safety. The real margin of safety is the difference between the asset value and the market price of a company that is fundamentally sound and has good credit. If all those conditions are present and you're buying $10 worth of assets for $6, you have an enormous margin of safety. I don't mind having a quotational loss where the market goes against me and my stock goes from $12 to $9 as long as I know it's worth $16. I have a real problem taking a financial risk where I buy the stock at $6 and they go bankrupt and this thing ends up at $0. I don't want to take that particular risk. So I always want to have a margin of safety. First question is always, is it safe? Then I'll worry about how much I can make. Here's just a couple of examples. Monster Worldwide, when the stock dropped down back in 2012, right about in here, it was trading at a pretty good discount to tangible book value. It would have qualified. If I was just worried about book value, I'd have bought the stock there. However, what the stock did not do was pass the credit checks. There was no margin of safety. The fundamentals of the business were actually deteriorating, and you can see what happened. The stock went up from up here between 7 and 8 down to $4.54. I don't want to take that kind of loss because I don't know that the conditions will ever improve enough for the stock to double and me to get my money back. It's the same thing with Corinthian colleges. The stock was definitely under book value all the way through the period that you see on this chart. They never came close to passing our fundamental screening tests. Rather than buying the stock up around 450, riding it all the way down to 220, the stock was cheap, but it was a horrible business with deteriorating financial conditions. Our credit and fundamental scores kept us out of that stock. So margin of safety is critical. A quotational loss is okay. A financial loss or a permanent loss of capital is not. Scale into stocks. This is kind of important too, because it's so easy to fall in love with the stock and buy too much of it. Um, buy your entire full position today. Odds are higher, particularly with a value situation. The stock's going to probably go down after you buy it. It's almost guaranteed, particularly if it's one of my stock picks. It's going to go down before it goes up. That's just how it works. This does hedge the risk a little bit. If we take a quick downturn and the market continues moving against you, you get a chance to bring your average cost down. Now, I do have a set of rules for adding a predetermined value of where you add to your position. I could talk about it for hours and have been known to. However, I do not have hours today. I only have 1 hour. So react, don't predict. 90% of what you see in the financial media on a day-to-day basis and what you're reading online is people trying to predict the stock market. It is the absolute biggest waste of time and resources imaginable. What I love is a guy comes on and he predicts the market and it goes up, and then he predicts it's going to go down and it goes down. He's got 2 lucky coin flips in a row. And now he usually gets anointed a guru. And you can think back to Elaine Garzarelli in the 80s, who got a call right. I don't think she ever got another one wrong, correct. But she raised hundreds of millions of dollars based on that one call. The stock market doesn't only measure the economy. It's incredibly psychological in nature. Absolutely nobody can predict what's going on. I can still remember at the start of Gulf War I, the 2 things that were absolutely supposed to happen when that war started was oil going up and stocks going down. First shots fired, oil collapsed, stocks went right through the roof. It's a waste of time to try to predict the stock market. You want to react to what it does. And this is, although Warren's not really much of a value investor anymore, think about his behavior in 2002 and 2003, where he was getting all in as things fell apart around him. He was reacting, not trying to predict the stock market. Now, the nice thing is if you're focused on valuation, I'm going to walk you through this a little later in this presentation. If you're focusing on valuation, you do have a little bit of a natural timing mechanism, because as markets sell off, there's more cheap stocks, and as they go higher, there's fewer and more stocks reaching their fundamental value limits where you're starting to sell. So, but please don't spend a lot of time and effort trying to predict where the stock market's going to be going. Nobody can do it. Patience is profitable. First off, you have to wait for the sell-off. You get about a 10% one every year on average. We haven't had one in over 2 years, which keeps some of us up at night. But on average, you get a 10% pullback about once a year. About every 2 to 3 years, you get a 10 to 20% pullback. And about every 5 years, you get one of 20% or more. So you got to kind of sit there and wait for the opportunity to present itself. During those times when you're waiting, you'll have a few cheap stocks around, so you're going to be, partially invested. But you want to hold a lot of cash, particularly after a very long bull run like we've currently had, where that Q ratio is over 1. America's assets are priced at more than what they're actually worth. So you want to have cash on hands, even though it's earning 0% interest. It's not exposed to a 20% loss either. Then when you get the corrections, it's like shooting fish in a barrel. There's going to be more opportunities than there is cash to invest in them. So you're going to be able to pick some great stocks at great prices. But rather than just sell them because they went up over the next 6 or 12 months, the key here is, again, exercise patience. You don't want to sell those stocks until they hit that full ongoing intrinsic concern value that I told you about. And sometimes, in fact quite often, when you're buying in a crash caused by economic reasons, that intrinsic value goes up every quarter. And it can take 5, 6, 7, even 8 years for the price to come up, to catch up to the full value of the company. That's how you get those stocks that Peter Lynch used to call 10-baggers, the ones that you buy at 5 and someday sell at 50. You don't need a lot of those in your lifetime to become a very wealthy investor. And 8, and this is a huge one, don't play just because the casino is open. The brokers want you to play every day, because certainly that's how they get their money. The guys on TV, they want you to play because they need the ratings. They need you in there watching. And you get into the casino aspect because you get caught into, when you're doing this, I got to trade every day. You start getting caught up in what I call the market darlings. and you're in these stocks that are trading well above book value. They're trading at 50 and 100 times earnings. They've got great momentum. They're moving all over the place, and it just looks like a trader's nightmare. But if you're not tied, I mean, trader's dream, I'm sorry, if you're not tied to that screen and able to sit there and watch it 8 hours a day so you know when to get out, or you have a reliable person informing you of when to get in and out of these things, you have a recipe for disaster. These are fantastic companies usually. Tesla, for instance, is probably a game changer. Amazon's a great company. I buy all kinds of stuff from Amazon. The UPS man sees me on a pretty much daily basis because I'm a big reader and I buy a lot of books. So, but as great a companies as they are, at 50 and 100 times earnings, these, you're not making an investment in a long-term business. You're buying a betting slip in a personality contest. So really, as a long-term investor, you're better off avoiding these high multiple stocks because you're flipping a coin on whether or not they can keep growing at 60 or 70%. I'll come back to Tesla, and I tell everybody this. Tesla's a great company, and they're doing some groundbreaking things. But whether or not we'll actually have charging stations all over the United States in the next 10 years is a question. And then think about this. What if they have to recall one of those cars for an electrical concern at some point over the next couple of years? That stock will take half of your net worth with it before you can blink. If you're not tied to the screen and you're not a daily trader, you really don't want to be in that stuff. Resist the urge. I can go weeks or months without buying or selling a stock. Treat them as businesses, not betting slips, and in the long run, you'll be a lot better off. All right, now this value at work, I'm going to walk you through this as a process. And I was researching some old stuff that I wrote last week when I came across this, and it's powerful, so I decided to put it into the presentation today. All of this is either in my blog or published on Real Money or Daily Speculations or one of the other websites for which I've written over the years. December 5th, 2006. Everybody's thrilled about the stock market. They're loving life. Well, I'm looking around and seeing that stuff's getting awful expensive. I got a lot of banks trading at 2.5, 2 3/4 times book value, which is unprecedented. When I run my screens, I can't find anything to buy. It's making me very nervous. I'm kind of looking around the world, and the people on TV are telling me that the market's, cheap, that, business is so wonderful and banks are making all these great loans and houses are going up 25%, and relative to the growth, the market's cheap. I didn't see it. There was so little to buy that the market did not appear cheap to me. So, and by the way, value's not a precise indicator. The market probably went up another 15% from this level, but I'm nervous, looking around, checking my portfolio, making sure that anything that's overvalued is gone, and being very careful about where I put my money to work. April 1st, 2008. I think the risk of being fully committed to stocks carries too many risks for the idea of margin of safety to exist. Over the next 6 months, everything that could possibly go wrong went wrong in the stock market, and it actually lasted all the way up through March of 2009 before we finally bottomed. So not great macro calls. I mean, I love to talk about macro stuff, but if I ever give you macroeconomic advice, do the opposite. This is simply a function of there's nothing to buy, and there's no pessimism around. Everybody's optimistic, and stocks are not cheap. June 2008. I'm looking around. Now there's nothing to buy. Markets are drifting around. The Fed keeps stepping in. I was terrified, as I think a lot of other people were, but people were still trying to get back in. This is around the time of the great Bear Stearns' fine call. At that time, I said, that only an illiterate, deaf, mute kamikaze could be aggressively long the U.S. stock market. There was nothing to buy, and what was out there was overpriced, and there was optimism, not pessimism, in the marketplace. From this call through the end of the year, the market went on to drop 40%. All right, now, November, let's watch value at work. Again, not a macroeconomic call on my part at all. I was as scared as everybody else that the world might end. But we were seeing companies trading way below book value for less than cash in the bank. They were trading for less than 3 times earnings, enterprise value over EBITDA. That's a sick low valuation for most companies. And we were just loading up on cheap stocks regardless of how scared we were of the market. we were in the depths of a bear market. Everybody was scared. The fear was growing by the day. The guys on TV looked like they were going to break down in tears. And because of asset valuations and asset valuations only, I was a pretty heavy buyer of stock at the time. March 14th, 2009, this is just a couple days from the bottom. Now, Doug Cass made a great economic call around that time and called it a generational bottom. All I said was there's an awful lot of cheap stocks out there. You could build a portfolio of 40 to 50 stocks trading for less than net current asset value, less than the liquidation value of the company. Disney, again, at that time was at 2/3 of what I thought it was worth. You had Hilltop Holdings, which was run by a distressed bank stock investor, was trading for 20% less than the cash that they had on hand. Dell was trading at about 1.6 times cash. Southwest Airlines was trading like nobody was ever going to fly again. And then my favorite was Forest City, a real estate developer that concentrates on New York City, had some senior debentures out there listed on the New York Stock Exchange trading at a 30% yield, trading at $4. They're about $26 today, because even if they'd have gone bankrupt, the real estate assets, even after the correction, were worth far more than the debt outstanding. So there was just nobody wanted to own stocks. People were scared. They were dumping stocks at a rapid rate. And it's not because I'm such a smart guy who understands the economy, but because I have learned to be a disciplined value investor. We were in there buying stocks just as they bottomed. And just a couple more I want to take you through real quick. In January of 2010, we were seeing the small banks start to really suffer from the baby with the bathwater effect. And these are your small 5 and 10 branch banks that they had no special purpose investment vehicles. They had not done any subprime lending. They probably didn't know what a CMO or some of those exotic mortgage-backed securities were. They were just regular little banks. But all of a sudden, they started getting sold off hard. And they were coming down to 70 and even 60% of tangible book value, in spite of the fact that they were pretty good little banks. I always call them Jimmy Stewart banks because they look a lot like Bailey Savings and Loan and It's a Wonderful Life. And we were starting to get our toes in the water and begin to buy those banks. And that is a trend that's going to go on and on and on for some time. They started getting cheap there. A lot of money's been made over the last 2-3 years in that area. A lot more is going to be made over the next 10. And then just finally, again, Europe is a mess in August of 2011. It's on TV every day. It's creating some situations back over here and creating market volatility. And because they were cheap, not because I really understand what's going on in Japan or Europe, but because they were cheap, we were buying Japanese banks and European financials. The result since that point of time, the lowest performer in there is Royal Bank of Scotland, and that's up about 80% from that point in time. All the others have doubled since that point in time. Not that I understand macroeconomics. The stocks were cheap, and the asset value was large enough compared to the market value that I felt like I had a significant margin of safety. Now let's look at today. And I want to make sure I don't run out of time here. I'll save you my own comments just because they are very much in line. These guys are a lot richer and smarter than I am, so we'll use theirs. Sam Zell is often called the grave dancer. He's CEO of a couple public real estate companies and has just made billions of dollars, bought the Tribune out of bankruptcy. So a pretty smart guy, been around a long, long time. He said earlier this year that this feels to him like the housing market of 2006. Everybody feels like they can't afford to miss it. He called it irrational exuberance, compared it to a game of musical chairs, and that those that got caught standing when the music ended were going to lose a lot of money. Seth Klarman is one of the most successful investors. He's of the last 25 years or so, compounded it well over 20%. Usually a very quiet guy. But he did speak at a private meeting. There's no such thing as private these days. If the comments got out to the internet, as did a copy of the speech. He just says, look, the content, although not the timing of the next chapter in the market history, is quite predictable. Everybody's going to say they didn't see it coming, but if you just took your blinders off and looked around, then you would know what was going on. His point is that when they do start to taper, and they remove the stimulus out of the economy, the disconnect between Wall Street and Main Street is so severe that you could easily see a decline of as much as 30% in the stock market. Now, when a guy as smart as this guy is, who's made so much money in stocks, distressed bonds, distressed real estate, and just been consistently profitable for 25 years, says, hey, the market could drop 30%. Yeah, I'm listening. I'm getting a little bit nervous, especially combined with the fact that there's a limited opportunity set right now. There's Leon Black, and Leon runs Apollo Global Investment Management. They're one of the largest private equity firms on the planet. And what's interesting about Leon is he cut his teeth working for Mike Milken back in the 80s, so he knows a little bit about leveraged finance and asset values. At the Milken conference earlier this year, a bunch of private equity guys were there. Several of them were talking about what a great environment it was to be selling assets, but they couldn't find anything new to buy with their newer funds. But Leon put it best. It's almost biblical. There's a time to reap and there's a time to sow. We think it's a fabulous environment to be selling, and we're selling everything that's not nailed down in our portfolio. Now, coupled with the fact that it's a small opportunity set and a lot of very smart guys starting to get nervous, and the fact that that Q ratio is over 1, it's probably time for most of us to be a little bit cautious in here. And I'm not predicting that the market's going to go down tomorrow. I don't do that. I'm just saying it's overvalued relative to what America's corporations are worth at this point in time. There are some places to be. We're going to touch on them very, very quickly because Kyle will be yelling at me here very, very shortly. Net stocks, I'll explain that in a minute, but if you see them, you buy them. It's just that simple. Let's just go through these. Nets are stocks that trade below 75% of their net current assets. Current assets are those things, inventories, cash, short-term investments, receivables, that can be turned into cash in 6 months or less. All we do here simply is we add up all the net current assets, and then we subtract out all liabilities, both long and short term. If you find a stock that's trading below 75% of the net current asset value, and it's high enough on my fundamental and credit screens, it's no question asked. I just buy them. I could be terrified of the market. It doesn't matter. I'm buying the stock. Right now we have 4 of them. They are all in the deep value portfolio, the domestic ones. They're retail, semiconductors, furniture, and even a little company that sells recreational vehicle and marine parts into the aftermarket. And we have 2 foreign nets that are currently on the list. I'm a little more cautious on foreign stocks than domestic, slower to include them in the portfolio. Haven't added them yet, but it's a pretty safe bet that I will on the next market pullback add those to the portfolio. If we find them, it's an automatic if they pass the credit checks for the most part. Materials, if you dig stuff out of the ground right now, your stock is cheap. And that includes iron ore, coal, gold, silver, copper, oil, gas. I don't care what it is. If it comes out of the ground, the market is discounting it. Yes, the economy's slow. Yes, there have been some stockpiles and excess inventories of these things, but they're getting worked off because everybody's cut back capacity and production in all of these industries. And again, my time frame is until it works. They're cheap. They pass the credit tests. Eventually, the economy picks up. Demand for steel, gas, oil and gas, copper, everything picks up. These stocks will, I'm probably sell at many, many multiples of the current purchase price sometime over the next 5 to 10 years. Small REITs, as overvalued as the large REITs are, the small REITs are about that undervalued because they're not in the indexes and ETFs. They're not getting those asset allocation cash flows to inflate the values. Right now we own some office property REITs at about 70% of tangible book, and we have everything from hotels to single family houses to apartments on the radar screen that if we get a little bit more of a pullback, we're going to be putting money to work in them because they'll have crossed below that magic 80% of tangible book value that we like to buy at. Small financials, we actually have a separate newsletter just for the small regional and community banks because they are so incredibly cheap and the opportunity is so large. There's a few brokers and investment bankers around that are just incredibly cheap relative to the assets. They're earning huge returns on capital, but because they're smallish, Wall Street's pretty much ignoring them. And then there's a couple niche asset managers that have a unique spot in the money management business that nobody else is doing, nobody's really paying attention to, but they're profitable. And most of those also pay very generous dividends. So those are the kind of areas where we're focusing on right now. But keep in mind, we're focusing because they're cheap and they pass the credit test, and there's not a lot of them at this current level. Now let's go walk you through a recent trade. Remember I said I don't really care if it takes 6 months or 6 years. Every once in a while you get one that just happens like bang. I don't know when it's going to be. The value can get recognized in a week. It can get recognized in 5 years. We bought Century Casinos simply because it traded below book value, near the current asset value, and had an outstanding credit and fundamental score. We bought it right around the time we started these portfolios in June at $3.50 a share. They came out at the end of July with a fantastic earnings report, way ahead of what anybody rationally expected from this stock. And we sold it on Friday for a 72% short-term gain because it had hit, or I'm sorry, on Thursday, it hit our intrinsic ongoing concern value. There was a temptation to hang on to it because the momentum was so good, but we live by the rules with the deep value portfolio. It hit the number. We sold out of the stock for a fantastic 72% gain. And it is this simple. We bought the stock at a price to book value of 70%, right there. Then right up here at 120% of book value, we're sellers. There's a bunch of other reasons and factors that go into the buying and selling decision. We don't have time to go into them all today, but we can, of course, expound on this in the seminar and in the future and in the newsletters. Using the simple combination of cheap assets and margin of safety in a relatively short period of time, we scored a fantastic 72% short-term gain for our subscribers. Doesn't always happen that fast, but sometimes it does, and you have to own the stock. You have to be in it to win it, as the TV commercials like to say. So real quick, just give you some flavor that that's not a one-off event. At the end of 2012, we picked some stocks for the annual mental waste of time exercise known as what's going to happen in the year ahead. Rather than make a market prediction, I stayed true to who I am, and I picked a bunch of cheap stocks. Hardinge makes machine tools. That's it. Very boring business. Nothing special about it. Nobody really cared about it because they were seen as being very anchored to China, and people were kind of worried about China at that point in time, back around the beginning of the year. Business came in better than expected. The stock recovered, took off like a shot. Year to date, it's up 54.8%. Tecumseh Housing Products. This is they make compressors for the HVAC residential markets and for large air conditioning and restaurant markets. Back at the beginning of 2013, there wasn't a widespread belief in the housing recovery or any sort of economic recovery. This stock was trading at an incredible 30% of tangible book value, in spite of they had decent fundamentals and good credit. Obviously, they passed the scores. Long in January, an activist investor came in, started pushing them to maximize shareholder value. They took some steps to cut costs. Business picked up, got better as the economy got a little bit better. And the stock's up about 142% so far this year. Bank of Ireland, tied into the European banking crisis. Nobody really thought that it would take hold, that the Irish austerity measures would work as well as they did. The stock was at 40% of tangible book value, and you had some really smart guys like Wilbur Ross of W.L. Ross & Company, one of the best distressed investors ever, and Prem Watson of Fairfax Financial putting money into the stock. At 40% of book value, it made sense to me. And the stock's up 41% since that period of time. And our last one, and this remains, here's your freebie for the day, one of my favorite stocks, Volt, is a staffing company that provides technical staff to companies like Apple, Google, big tech companies. There's some questions about restatements of the financials, but when you go through and work it out, the stock's trading at about half of book value, and it's up just about 13% so far this year. And those were just my 4 picks for the year ahead. As a package, clearly they've done very well. So that's kind of where I am. I can teach you to do this too through seminars, through the newsletter. In addition to providing stock picks, my biggest goal is to continue to educate you and make you a much better investor over time. I see that I have about 6 minutes left on my magic time period here this afternoon. So I'm going to throw this slide up, and I'm going to ask Kyle if I have any questions.
Great, Tim. Awesome, man. Yeah, we only do have 6 minutes left because we do got to keep moving on, but I have a ton of questions for you. I'm going to run over this offer real quick. As you know, we're offering something at the end of each presentation today for you attending. and I had to beg Tim to do this one because Tim does not give this stuff away very cheaply. And his workshop is called Finding Value. How appropriate. Investor Workshop. He's going to teach you, guys, this is amazing. He's going to teach you how to research, identify, and buy stocks that beat the market, okay? It is going to be a 2-hour special live online seminar only for people that are purchasing from this today, okay? So I just dropped the link inside the chat. It's only $47. People pay Tim over $1,000 an hour just for his time when they're going over their portfolios, and he's giving this away 2 hours for $47. It's Wednesday, September 25th from 4:30 to 6:30 p.m. Eastern. I know everyone's asking right now, will it be recorded? Of course it will. We always make sure if you can't attend that we get you out of recording as well, okay? You are going to learn the tools and, more importantly, the methods that Tim uses. So he went over his 8 rules today, but there was a lot more that went into it, right? Today we really concentrated on price to book. There's a few other things that you need to look at, and he'll also go over stocks that he's looking at right now that he believes are undervalued. And then he'll also share, and this is awesome, and he was not happy with me when I asked him to do this, but he will share his favorite 2 deep value stock picks right now, okay? And they have a lot in the portfolio right now, but he's going to share 2 of them with everybody that buys this seminar, all right? So the link's inside the chat. It's only $47. All right, Tim, with the sake of time, I only got 4 minutes, so if you can give us brief answers on some of these, I'd like to get a few of them done.
Okay.
I have Wong asking, why do you look at price to book value? There are a lot of people that focus on the PE ratio or the PEG.
Book value works better. PE and PEG can be manipulated. Assets can't.
Perfect. All right, so Greg M says, are you saying one should sell these real estate stocks right now?
Yeah. Yes, I am.
It's pretty straightforward. A lot of times with Tim, and how many conversations you and I have had on the late nights about, it's straightforward. It's black and white, and the biggest problem is patience. But if you can do that, you can really make money value investing. And Tim, not only Tim's performance shows it, and his customers are out of this world for him, but the strategy alone is time tested, which is something that's really cool. Okay. I'm looking at Wong again. This is cool too. He says, price to book value is suitable for all sectors and stocks. And I think that's a question I had early on with you, Tim. This applies to everything, right? All sectors, all stocks, it doesn't matter.
Yeah, there's some minor variations in the level of price to book value where you might want to enter, but yes, it works across every industry.
Cool. Amy, she's asking some tools about how to find book value. You can find book value on like Yahoo Finance, but in terms of like going it more in depth, attend a seminar. He goes over all that, and for $47, it's nothing.
And big warning here. What you see in 90% of the screeners online is intangible book value. It's stated book value. Huge difference. I'll be teaching in the seminar how to separate it out.
How does your methodology differ from Vanguard and John Bogle?
Vanguard and John Bogle buy indexes and just hold forever. I buy cheap stocks and hold them till they're expensive.
Does Tim only buy those stocks with high and good dividend yields, or just buying those that are boring, slow and steady stocks?
We'll buy a high dividend stock if it fits.
Yeah, you can see that they're not all just the boring ones. I mean, the subscribers that made 72% in 3.5 months, that would move fast. Now, again, they don't all do that, but there are ones that will, and they got in on that one. Now, Tim, why did you sell that one? Talking about CNTY.
Because one of our measures is intrinsic going concern value. That's the full value of the company according to my methodologies. The stock was fully valued based on the value of the business.
Great. All right. Alan asks, do you differentiate between hard assets and intangibles and soft assets like goodwill?
Yeah, no intangibles, no soft assets. If they eventually turn out to be worth something, fantastic. That's a bonus and an extra margin of safety. I do not use them in my calculations ever.
All right. And Tim, you kept saying I'm afraid of Kyle. I take that as a sign of respect. You don't give that to me too much when it's just you and me. But I guess I just had to get you in front of a group of people.
Yeah, it's going away the minute this call is over.
All right, last question. 30 seconds left. Tony L asks, how do we use your method on a 401k?
It depends on whether or not you have a flexible 401k and can buy individual stocks. If not, you'd have to look for value funds. That's a little more difficult, and probably it's a whole seminar on its own.
All right, we have a ton of questions about Tim's products. I'm going to send these questions over to him because we're running out of time here, and I got to bring the next person on. Again, look at the link inside the chat. This is a no-brainer buy, guys. I mean, I have learned so much from Tim. It's unbelievable, and I've met guys that have been watching him and reading him on realmoneyatthestreet.com for a really long time. Tim's just been doing it, and he's been doing it successful, and he's one of the guys that has consistently beat the markets, right? I've met a lot of people that have done well in a certain market condition, but Tim is one of those guys that over the long term, he's that horse you bet on the long term. So, Tim, hey, I really appreciate it, buddy. Great presentation today. I feel like everyone's loving it right now. I got Segfire, Michael, Brad, they're all coming in and say thanks a lot. So, Tim, enjoy the rest of your day. Your Baltimore Orioles are down 3-0 right now against Tampa, so it looks like you guys might be sliding out of the playoffs here.
Yeah, unfortunately it does. I think last night's game, 18 innings, broke our back. But, oh well, it's been a good year.
All right, dude. Again, I'm dropping that link one more time inside the chat. Tim, as always, buddy, I appreciate it, and we'll talk to you soon, okay?
Okay, thanks.
All right, folks. Everybody stand up. Stretch. Get those arms up. Touch your toes. We got up next. I got something a little bit special coming up. We have one more sponsorship to talk about, and this sponsorship is so cool. And I'm bringing on right now Stephen Perez, and Stephen is from FXCM, who is one of our big sponsors on Marketfy, and we've started to partner with over the last month. And we have something really, really cool to offer everybody today. So at the end of his 5-minute presentation, which I'm giving him the presentation right now, he is going to be offering something for all of our purchases today that you will not believe. So everybody stay tuned to that. Steve